Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. In these bonus podcasts, we talk about the best strategies for making the most of your money. I am Merryn Somerset Webb, Bloomberg UK Wealth Editor-at-Large. And with me, of course, award-winning, there's another award, isn't there, John? Award-winning senior reporter and author of the Money Distilled newsletter, John Stepek. Hi, John, tell us about your award. Come on, get it over with.
Hi, Merryn. Actually, I'm not allowed to because it's embargoed until they announce it. So anyway, There you go.
Okay, well, watch this space, everyone. So that's exciting news, an award we can't tell you about. And also the other thing I wanted to tell you is that it's Rapture Week.
Well, yeah. I sort of saw some mutterings about this, but I'm not really. I think I've avoided the topic.
Yeah, you're missing all the important stuff. Times are tough out there and the world is ending. Well, actually, I'll tell you what, listeners, if you hear this podcast, it probably hasn't happened. All right, because today we're recording on Tuesday, and that is End of the World Day, according to those who believe in the rapture. Though, of course, having thought of that, think about that a little further. John, I'm kind of guessing that neither you or I are going to be lifted up. So actually, you'll probably hear this podcast anyway. Our producers will still be on it. We'll still be here. I mean, maybe not much will change. I'm just going to leave that topic completely.
Literally enjoy Merryn Talks Money in hell. That's a nice thought for the weekend.
I was hoping for purgatory.
No such thing according to the Pope, I think.
Really?
Yeah, did he not change his mind about that, or was that limbo? Actually, that might have been limbo. Anyway, we are getting way down the theocratic mine hole here, so...
I have not been fully focused. I will come back to this another time. Anyway, luckily, we have a very informed and very engaged listener base. I'm pretty sure one of them is going to email in and tell us the difference between purgatory and limbo. Go, listeners. Now, we are going to answer a few questions from our readers. And the one other thing that I want to address before we get going on that, lots of you will have listened to the episode that I did last week with Mark Wood, who's chairman of Everest Funeral Concierge. We spoke about withdrawing the tax-free amount from your pension fund and the potential changes coming in 2027 and what you might or might not do about that. Lots of you already know exactly what you're doing. There's been 70 billion quid pulled out of pension pots in the last 12 months as people desperately try and get ahead of any nasties coming up in the budget. We'll come on to that in a minute. But clarifying a few points, so I want to reiterate this and to make absolutely clear what the reality is of this. Mark suggested during our discussion that taking your 25% tax-free lump sum at age 55 or later means that you have effectively retired and can no longer put money into your pension with tax relief. That's not quite the whole story. It is correct that from the normal minimum pension age, which is currently 55, it'll be up to 57 in 2028, and trust me, it's going higher, you can access up to 25% of your pension pot tax-free. Now, if you also start taking taxable income, i.e. drawdown or more lump sums, at that point, something called the Money Purchase Annual Allowance, MPAA rules apply, and your future tax relievable contributions are capped at £10,000 a year. There are also various rules around recycling, so you're not allowed to take money out in your lump sum and then shove it back in again. That's against the rules. That's recycling. You will get in trouble. However, so what this means is that withdrawing the lump sum alone and not putting it back in again does not mean that you are treated as retired. You can continue to contribute to your pension and to receive tax relief on those contributions, subject to the standard annual allowance. Right, that out of the way. We've also had quite a lot of feedback about the Dieter Helm interview. Not all of you were happy with that. Maybe you don't share the opinions, etc. But I thought it was personally, I thought it was excellent, but I would, wouldn't I? John, you weren't here for that interview on one of your many, many holidays. How you get all these awards when you're always on a beach, I don't know. But you listened to this one, or I hope you did, while you were on a sunny beach in Greece. And by the way, everyone, while in the pre-chat before we started recording, John has been giving me advice on where to go on holiday in Greece, because that's how often he's been on holiday this year. So while you were in Greece listening to this, what did you think about it?
I thought it was great. And I thought it was great because I think it's the clearest explanation of what the issues are surrounding relying on intermittent sources of energy for all of our energy, particularly in the UK. And I have to say, the other thing I thought was good was that I thought that Dieter pushed back at you quite a few times whenever you raised points with him. He's clearly not rabidly anti these sources of energy. He's just pointing out the practical issues with over-relying on them. So he said that it was fine to build more of X and more of Y. It's just that you need to be aware of what the problems are. So no, I thought it was really good.
Okay, interesting. But I do want to just add one thing to that. Some people have commented that they see that episode as political and leaning to the right. Now, I think that brings us into a definition problem of what is right wing and what is left wing. But either way, the intention of the show is not to be political. We are concerned with the economic prosperity of the UK and how we can make it better. We're interested in abundance, we're interested in plenty, and we're interested in wealth. Now, Dieter was very frank regarding his opinions on the UK's energy strategy and the performance thus far of Ed Miliband, but this is not about politics from his point of view. It's about research and it's about evidence. And now on to today's show. In the spirit of hearing from you listeners, and actually even maybe listening to you listeners, we have decided to have a mailbag episode. We're going to answer a few of the questions you've put to us. Some of them you sent to me directly. Some of them you sent to our email address, which is merrynmoney@bloomberg.net, for those of you who haven't done it yet. So to kick things off, and by the way, some of these questions are more statements masquerading as questions, but we're going to make them into questions to a degree. The first one, ostensibly the question is, what can Rachel Reeves still tax? And then Nigel, who's written in, tells us what he believes should still be taxed. I mean, I've just got quite a long list of things that Rachel could still tax, but I'm not sending it to her. So Nigel suggests that we should tax all the things that we currently do not pay for all the things that are currently free. So what this means, he says, is you effectively make it illegal to sell anything below its actual cost plus 5%. So all the things we get for free, podcasts, online exercise classes, online training, etc., all these would be put on the subscription model, and then a sales tax is imposed on top. So Nigel's wife, for example, who uses a free Pilates podcast compiled by people all over the world, but her use of that podcast gives no revenue to the UK government. She could be paying a subscription and VAT. Now, Nigel, I suspect that's possibly the most unpopular thing that has ever been said on this podcast, and it's a very, very high bar. John?
I mean, if the way to charge for free things was just to put a price on them, then the media in this country would not be in any trouble at all in our business model. We'd be rolling in it. We'd all just launch Substacks and take the money ourselves.
Damn right we would.
I feel this is impractical. I also hope that Nigel's wife doesn't listen to the podcast.
Yes. I mean, I suppose the other thing I would say is that you're right. If putting a price on something meant that you could sell it, everyone would have put a price on. But if everything had the same price on it.
I know, but what are you going to charge for the air as well? I mean, you just stop listening to podcasts.
Oh, we're just getting to that because I just said that was the most unpopular thing ever said on this podcast. But Nigel has raised his own bar with his second suggestion. Nigel's second suggestion is that the cost of a unit of energy and of water should escalate pro rata to the amount used. So heavy users, by which I assume he means those with swimming pools, would be paying a lot more per unit for their top end use than they would for the first few units. This would encourage investment in energy and water saving devices, but also provide funding to allow a very basic, tough to keep within amount of energy and water to be made available to every consumer for free. You're too good to us, Nigel. I mean that if you find yourself unemployed, you still have a little water to flush the loo and to drink. Well, that's nice. This is essentially a wealth tax. Yes, it is, but would end up driving the innovation to lower consumption for all. Now, John, I'm going to let you have your rant on this in a minute, but the risk of sounding right wing, my own view on this is this suggestion is exactly the problem, that we should find ways to use less, not just to be efficient, because we're all pro-efficiency. Let's do more with less, but let's not always aim to use less. Let's aim for abundance. Let's aim for plenty. Let's aim for rising living standards. Let's aim for long, hot showers, right? Let's not aim to make stuff worse. John?
Yeah. I really dislike this sort of moralising almost about something that is also not, it's not, it shouldn't be necessary to ration water in this country for a start. And I mean, one thing,
Scotland, I'm telling you, there really is plenty of water.
Exactly, especially Scotland.
Build a reservoir.
Yeah. I mean, one thing, to be slightly fair to Nigel, is that some countries do actually price water and energy along these lines. Like, I'm pretty sure that Portugal has. I don't think it's so much there's a free bit, but there are kind of domestic rates and then industrial rates or whatever. Once you get above using a certain amount, it jumps. And I guess that in a kind of particularly water scarce country like Portugal, that is maybe a more appealing approach. But also, I mean, the other thing is, so if you find yourself unemployed, you still got water to flush the loo and they drink. I mean, there's lots of unemployed people in this country and none of them are short of water. So actually, Nigel is sort of talking about a kind of drastic change there. So no, I just don't think either of those are practical.
Maybe Nigel lives in
That's
Portugal.
true.
I don't know. Anyway, Nigel, I didn't mean to be unkind. Please keep listening and please keep sending in your ideas. We do appreciate them. It gives us something to talk about. Thank you. Right. Now we're moving on to Tristan. And, well, you know, as I say, high bar, but boy, these people can jump it. This is Tristan wonders if there should be a tax on social media. As a concerned parent, I'm with him there. I am also a concerned parent when it comes to social media. I'm against most forms of social media, so I'd be keen to nickname it the toxic tax for the damage it is doing to young people and society as a whole. Okay. There is probably an applicable Adam Smith quote. There is. I should be adding here. I'll find it later. I think the simplest way to think of it is to use the cliche of there is no such thing as a free lunch, to highlight that while people may consider the consumption of social media to be free, they are paying for it in other ways. I think most people, maybe not all, and particularly not young children, but most people understand that it's a straightforward swap, entertainment for data, addiction for data. For implementation, I was thinking that either a flat charge could be placed on the mobile phone and broadband bills for anyone wishing to have their data social media enabled, or potentially a data-dependent variable charge with a cap to avoid young people racking up big bills, etc., etc. And then he suggests that public Wi-Fi's in cafes, libraries, schools, hotels, workplaces, etc., would then have the option of restricting social media or not, as they wish. Now, this is all about trying to reprice social media to reflect the negative externalities that they impose and to send a message, particularly to young people, of how damaging they are, in line with similar other activities, drinking, smoking, driving. Now, I can't even begin to see how this can be implicated, but actually, I am all over it. This is an absolutely fantastic idea. It should be taxed. Or, well, okay, taxed is maybe it's not that straightforward, but it should be disencouraged. I listened to Tim Berners-Lee speak the other day, and he had this very interesting idea about social media and phones because, you know, he genuinely feels that this is a terrible thing for our young people, a terrible thing for our children. And it's one of the big downsides, of course, to the World Wide Web that he actually invented. And his thought was that there should be a specific simple phone initially designed specifically for children, for the under 16s or the under 18s, that cannot be social media enabled. A simple old-fashioned phone that is only a phone and a texting device, a WhatsApp device. You know, maybe they can have one or two things bits and bobs, but maybe that's a blur thing. Gray areas all over the place. And you might say, well, this phone already exists because you can use your family protections to chop all sorts of things off your children's phones. And so you have to get permission if they download this or download that or download this. But nonetheless... Oh,
no, the actual phone exists as well. They do have models.
Does the actual phone
they're called dumb phones. And there's a lot of them.
Oh, yes.
You know that young guy that writes about how reading is kind of collapsing the Times journalist. He's very good.
Yeah. No, I know that the phone itself exists, but that's not Tim's idea. Tim's idea is that this is compulsory for the under 16s.
Okay.
So in the same way that you can't buy cigarettes until, I don't know, when can you buy cigarettes? I have no idea.
Well, these days you can't ever buy them, can you? Because you're like under 18 and then it keeps ratcheting up until you're going to be 30 and you're not going to be able to smoke. I can't remember. Some stupid thing that Rishi Sunak did in desperation before the last election.
I'd forgotten about that. But yeah, so it's not about cigarettes. So,
yeah, it's not.
But, you know, all those surveys that constantly show that most children say that they would love to not have social media, but they have to have it because everyone else had it.
Yeah.
If you could put, maybe it's only 14, maybe it's 13, maybe it's 16, I don't know. But if you could put a blanket ban on it, I hate banning stuff. I'm a libertarian at heart, but sometimes, you know, you do look at this stuff and think, actually, maybe it's time to do something.
I agree with the basic point, and there is a sort of reverse tragedy of the commons going on with social media that you just pinpointed, which is that everybody feels they have to use it, even though each individual or most individuals are like, I hate using this stuff. And looking at my own kids, I feel the same way about it. I think it's more about finding practical ways to do it. And I think taxing it, the problem with taxing it is, like, for example, see when we actually got serious about smoking and we banned it in pubs, that kind of went against every libertarian instinct that I've got. But it worked. And it actually made going to the pub much more pleasant for most people. And I think the problem with this idea that tax is actually a form of banning stuff is nonsense. I think what you have to do is if you think that something should be banned, then ban it. Right? If you don't, then, taxes should be raising revenue, ultimately. Too much of this social engineering is going through the tax system. And it's busy. It's like we've sown a whole load of weeds, and now nobody knows what the tax system is for, which is why we get so many useless budgets coming up. So I think Tristan's heart is in the right place. I think his solution is completely kind of bonkers, and it just adds yet more weight. It shouldn't be on the tax system. It should be on our legislators to come up with a way, like Tim's suggested, of rendering every smartphone illegal for the under 16s or whatever you want to do. But I think that is the route to go down, and just confront the fact that we are actually being anti-libertarian. We are saying to people, no, we don't think this is suitable for kids, and so we're going to ban it in this country. I think we just got to confront these things head on, as opposed to messing around, because what, you tax it, so what? It means that just the wealthy kids have got it, or you're just you're going to entrench certain social mean girls problems even worse then.
Okay, so don't tax, just ban.
Yeah.
Interesting what you say about trying to use the wrong instruments for the wrong things. The idea of using the tax system to try and disencourage things that maybe should just be banned outright, to the extent that we agree with banning anything ever. And then things like, using GPs, using the NHS to police the benefit system, using people working in call centers to try and tell whether people are telling the truth or not. We're using the wrong things for the wrong things. That's a different podcast. Come back to that another time.
Yeah, but I mean, it's nudge ideology has been toxic, even if it was a good idea to come about to start with. But anyway, it is another podcast. We should do something on that.
Yeah, we should probably do something on nudge. We did interview the nudge guy once. Right. Anyway, moving on. This one is shifting away from banning stuff and taxing stuff and back to investment. Outlook seems quite gloomy. Yeah. It's tempting to allocate much more heavily to absolute return funds. Funds like Argonaut Absolute Returns, Go Barry, and AQR Apex have been delivering great returns for a number of years now. And based on all the doom and gloom I'm hearing about the global outlook, I'm wondering why I'm invested in anything else. Absolute return sounds rather nice, yet typically people don't invest more than 20% of their portfolio in such funds. I'm not sure many people invest 20% in. What factors should I consider when thinking about allocating more unusually like this? I mean, this is an interesting one, John. We've talked a lot about absolute return funds over the years, and one of the questions one should ask is, why isn't every fund an absolute return fund? The idea of relativity has always been ridiculous, that you pay someone a lot of money and their job is to beat an index, when in fact their job should be to make you some more money than inflation. If you just want inflation or a little bit more money than inflation, then these days, you can have a deposit account. That's nice. You couldn't for a long time, but now you can. And if you want to have, a couple of percentage points above inflation, then you should be able to go and buy an equity or a multi-asset fund. And you should be relatively confident, if your manager is competent, that you should get that on a rolling 3-year basis, right? That seems entirely straightforward. An absolute return fund, by the way, for anyone who is not experienced in this area, it's effectively a multi-asset fund that aims not to track an index or not to slightly beat an index, but just to make you money every year. And I can hear you going, well, surely everyone's supposed to do that. No, they're not.
Yeah, it's usually like inflation plus X% or something. I mean, I think the big problem with absolute return funds is basically what you've said. And as a result of what you're saying, they all have different ideas about how to deliver the absolute returns. So I think if you look inside the sector, you'll find there's quite a big divergence in the best performers and worst performers, and also in what they hold. I mean, Argonaut is a great fund, to be very clear, but usually when people think about absolute return funds, I think they would tend to believe that they would be on the lower risk side of the spectrum, and whatever else Argonaut is, and Barry certainly wouldn't claim that it isn't. I would say it's a higher risk one in terms of volatility, exposure to equities, exposure to things like Argentina and things like that. So, and whereas the other ones that are kind of maybe not as interesting, or I've held a lot in bonds or gold or whatever. I mean, well, not gold, but recently a lot of the absolute return investment trusts have not done that well. And I think this is the problem. I think you really need to look at the individual fund, and I'm not sure the label absolute return tells you very much, except giving you a rough idea that it's not benchmarked to anything specific other than inflation.
I suppose the answer is it's not any easier than investing in any other type of fund.
Yeah.
Sorry, Tim.
Yeah.
But we approve the concept. Right. Next question. Bitcoin investment via listed vehicles. You suggested this was new and the market value to NAV premium reflected scarcity. I said we didn't suggest that it was new. We've suggested that the Bitcoin treasury business was new to the UK. And so Jeff suggests we look at the Grayscale Investment Trust, which is a US listed stock invested in Bitcoin since 2013. Gosh, I hope some people were in that. It initially went to a massive premium to NAV, net asset value, then fell to a huge discount, around 50%, recovered to 100% when it converted into an ETF. Take a look and see if you think the new listed Bitcoin players look just like Grayscale did in its heyday. And the answer to that is yes, absolutely, they do. And we agree entirely. He finishes off by saying, do we not find historically that investment trusts at massive net asset value premiums quite often tell you the underlying asset is fashionably overpriced? I think you know the answer. Oh, we do. We know that answer. John, do we know that answer?
Yes, and I appreciate Jeff writing in to tell us something
give
that
us
we entirely agree.
Yeah. Give us the opportunity to read out our own views. Exactly. Thank you, Jeff. Okay, one more question. As you know, two more questions, but they're kind of the same question, actually. The first one is 52 billion pounds in debt seems like rather a large problem. We've had a great ride this past 8 months, but will our UK debt unravel it all horribly somehow this autumn? That's from Stuart. Oh, hang on. The next one's also from Stuart. Is it the same Stuart? The next one, different
it's
Stuart.
a similar question.
Okay, producer says it's a different Stuart. Hello, Merryn and John. I'm a regular listener, follower of your podcast. So any chance of discussion on the doom loop and what private investors should do in a doom loop? Well, the first thing to say is that, boy, do I have disappointing news for you, Stuart, number one, which is that 52 billion is nothing, absolutely nothing. In fact, the UK level of debt is about 2.9 trillion pounds, which is closing in on 100% of GDP. Last year, or the year up to end of financial year March, we borrowed 146 billion pounds, and we are spending 8.5 billion pounds a year alone on interest payments. And by the way, and rising. So yes, going on 3 trillion pounds worth of debt is a large problem. John, you got thoughts on that?
No, other than the only upside at all is that we're not the only country that's in that situation. And this technically, well, one thing I would make clear is this technically should be manageable if the people running the country are competent enough to manage it properly. And I think that actually is, and I'm not even joking, I think that is where we have the problem right now. Britain does not need to be in as much trouble as it's in. It needs more effective leadership, and that's the missing component.
Yeah, and the question here is, what will happen? How bad will it be? Are people watching? I mean, there is that wonderful thing we say often in the UK, the world is watching, when mostly it totally isn't. And when you simply doesn't care. When you look at the market, there was, I don't know if you wrote about this, John, but the Bank of America, the most recent survey is showing that the flows out of the UK were huge, and biggest month of outflows of equities in the UK since the early 2000s, and global allocators less keen since the beginning of time, et cetera. But that's a survey. That's not real life, right? And so it's what they say rather than what they do. And if you look at the market itself, there is no evidence that there is a massive outflow of capital from the UK equity market. Most of our indices are, well, not all of them, but the FTSE 100 is knocking around its all-time highs, and the 250 isn't that far off its highs for the year. Sterling is kind of okay. Gilt yields have come down a little bit. So I'm not for a second suggesting, don't get me wrong, that there's anything good about the UK economy, or about, well, there's good things about the UK economy, but about the UK public finances, absolute rubbish, remaining rubbish, and no clear plan to make them less rubbish. But that is something that for our equity markets, at least foreign investors appear to be prepared to overlook.
Yeah, because it only matters to an extent for the equity market. And the main issue for the equity market, again, is how the government kind of sorts it out. this is the problem, because we're going to be all sitting chatting about this right up until Rachel Reeves sits down on November the 26th. And then beyond that, we need to worry about whether she can even make whatever she does stick with her own party. Because, we could end up getting the Chancellor and the Prime Minister replaced at some point in the next 12 months. That's certainly not beyond the bounds of possibility. But I do think that the vast majority of the risks facing the UK are political ones rather than financial ones, because we are by no means the only country with public finances this bad, and it can be solved. And we're the second fastest growing economy in the G7 right now, which is, because the other 5 are terrible, but it's still, it's still something we should be able to get out of this if we can just get a bit of sense. And that's the only thing that's missing.
Well, as we keep saying, there's a lot wrong with the UK, but there is nothing wrong with the UK that can't be fixed by better policies.
Yep.
Someone one day will bring us those. There's going to be a lot more talk about this on this podcast over the next little while. We've got a lot to say about tax and a lot to say about budgets. But, we'll save some of those joys for later in the month, shall we?
Good idea.
Oh, doom loop, by the way. What should you have in a proper old doom loop? Well, I think you know the answer because you're buying it already. It's probably gold.
Yeah. Aye.
And it is out there. I'm listening to the radio in the car this morning. Long chat about gold. And I am also hearing from friends at the big asset managers that those fund managers who've been sniffy about gold for forever are starting to buy it on their own accounts. So, getting out there. Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi and Moses Andem. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.